Christina, over to you.
Thank you, Vitaly, for the introduction, and thanks for inviting me. Really exciting to be here. So I'm here today to discuss the short-termism of capital markets and how we can shift the focus towards the long term, which is really a topic that we at KKS have been investigating a lot in the past. So let me change slides. So currently, actually, at KKS, we're working with a large NGO to understand how the capital market system can respond more quickly and comprehensively to the risks and opportunities that climate change pose. And one of the key findings from this, in terms of the barriers, is short-termism. And that will be what I'm going to talk about today. So I'll start by discussing short-termism and its problems, and then diving into one of our latest pieces of research that explores the benefits from increasing disclosure and long-term strategies, both for investors and for companies. And I'll also show you a framework that we created for effective long-term strategies. Now, there are obviously several other ways and different actions that can be really effective at helping this transition towards a low-carbon economy, in addition to overcoming short-termism, such as policy change or requiring more transparency and disclosures of ESG, which is environmental, social, and governance issues, or also limiting carbon-intensive investing, and so on. But really the focus in this discussion in the webinar today is how to bridge the gap between investors and companies to focus our capital markets to the long term. And I also wanted to add that to stay up to date with our latest research, if you guys are interested, you can follow us on LinkedIn or Twitter and sign up to our newsletter as well. You can tweet at us at KKS Advisors and use the hashtag Reshaping Markets, because that's our vision. So moving on. Basically, our capital markets fundamentally exist to channel investments to create growth and to raise long-term finance. So in the light of this, short-termism in our capital markets is basically a result of several different factors that push executives and senior management to make decisions that increase their share price in the short term, with the expense of making effective decisions that could benefit the company in the long term. And I've picked up a couple of main drivers for the pressure on executives and senior managers. The first one of those is the focus on quarterly earnings calls. These are frequent earnings updates, which have led to companies focusing on meeting or beating the quarterly targets, which is an expectation that is held by investment analysts. And we've actually previously done a lot of research on these efficiencies of quarterly guidance, so please check those out on our website. Another factor is that activist investors are often demanding that companies should return the money rather than spending it. And then the third factor for this pressure is that quite often executives' compensation can be tied to the performance of the share price rather than the long-term performance of the company. And this really skews the incentive for the CEO to make lasting investments. So why is that a problem? Given the urgency to act on and address climate change, short-termism really is at odds with sustainable development and with sustainable growth. So today, actually, increasing attention is being drawn to the role that our capital markets can play in mitigating, for example, climate risks. So channeling capital towards companies and initiatives that can speed up the transition to a low-carbon economy is really more important than ever today. In addition to climate change and sustainability in general, short-termism also means the inefficient allocation of resources. So companies are returning money to shareholders through dividends or share buybacks. And if companies sit on a lot of excess cash and already have a high capital expenditure in R&D, then returning it to shareholders could really be perceived as the right thing to do. But the problem arises when companies are giving the money to shareholders to boost the stock price rather than spending it in ways that could increase long-term value. So they're basically ignoring projects that might give a competitive advantage in the medium or long term. And that means essentially lower innovation and lower economic output overall. And then another negative impact of short-termism that we've seen in the public market is that the number of public companies have reduced by roughly 50% since 1996. And those companies that go public, they actually tend to do so later in their life cycle today. And there is a lot of research that has showed that those sectors that have the most short-term pressure also have disproportionately lower listings activity. So shifting the focus of our capital markets towards the long term could really help boost and stimulate the public markets so that these wealth creation opportunities that it offers would be available for everyone. And now you might ask, who's to blame for this inefficiency? Well, funnily enough, CEOs complain that investors do not ask about their long-term plans or strategies. And on the other hand, investors are complaining that companies' disclosure discourages them to engage on long-term metrics. So that's essentially why short-termism is a problem. So how can we bridge this gap between companies and investors and solve their debate? Well, one solution that has been proposed to this dilemma is to improve the overall quality of company disclosures. So investors need to receive more actionable information about the long term so that they can include this in their decision-making progress. And companies could provide this without revealing too much about their strategies to their competitors. Now, the answer is not necessarily to scrap the quarterly earnings altogether, but rather to change the mix of information that companies are providing. So in other words, to provide informative long-term disclosure and targets to investors in addition to the short-term data. To investigate whether giving more long-term data to investors has an impact or not, we at KKS partnered with CECP, which is the Chief Executives for Corporate Purpose, to analyze whether investors actually care about the long-term information and to build a framework that could help companies structure effective long-term disclosures. The interesting thing about CECP is that they organized a CEO investor forum, which acts as a platform for CEOs where they can present their long-term plans to investors. So what we did was that we took all of these long-term plans that the CEOs have been presented at the CEO Investor Forum, and we analyzed the content and we analyzed how the markets were reacting during the CEO presentation. I'll walk you through our findings and the framework that we've created now. So, do investors care about long-term information? Our results suggest yes, but actually not all investors care. So by analyzing stock prices, trading volumes, and analyst forecasts, we found that yes, there are abnormal returns in trading volumes of those companies that presented compared to the expected of the market when it comes to the return and the volume. And this means that the long-term plans do contain some information that investors are trading on. And this is really great news for companies because it means that by disclosing more long-term information, the companies might be able to attract capital that would allow them to make investments to innovate or increase their competitive advantage in the medium and long term. And our other finding from the market analysis was that analysts don't revise their forecasts after hearing a CEO's long-term plan. And this is maybe not so surprising, as the analysts that make these forecasts, the sell-side analysts, they're primarily focused on the short-term financial results that you can hear in the earnings calls. So that wasn't that surprising. And these results are really exciting. Even though our sample is quite small, actually, the fact that we find these results show early evidence that providing more information about the long term is beneficial for the company and is value relevant for some of the investors. Given that the market reaction is there, what is it that companies should disclose on? What are the building blocks of a good long-term strategic plan? And what kind of themes should companies mention to their investors? Well, we carried out an extensive analysis of literature and initiatives such as SASB, which is the Sustainability Accounting Standards Board, and Integrated Guidance Framework, and so on. And we created a list of themes and issues, which you can see here on this slide. After several iterations between our research team and a selected group of investors, we structured the themes and the issues into this framework. And it consists of 9 themes and 22 underlying issues, which are the ones that we believe that are potentially valuable for investors in the long-term plans that companies can present. So you can see here issues such as financial performance, capital allocation, and trends. And these 3 are perhaps obvious when you think about a long-term strategy, but it's been really interesting to see that, for example, corporate purpose is important for investors too. And corporate purpose is actually something that George, our founder, who's a professor at Harvard, he recently did a research piece on that. And basically, what he finds is that corporate purpose is linked to financial performance when it's defined as the employee's beliefs in the purpose of the organization. So in other words, not just what the purpose actually is, but rather if employees really believe that the work that they do have a purpose and a meaning, then the company is also likely to perform better as well. So therefore, companies should disclose how their purpose is linked to their long-term strategy and to their goals. Likewise, you can see that corporate governance is an important theme for companies to provide long-term information on. And the issues underlying this theme include, for example, executive compensation. Sorry. Apologies. One of the
yeah, no worries. Take a second. It's hard to keep going.
So yeah, one of the issues under corporate governance is executive compensation. Wait, I might need to go and get some water.
Yeah, no worries. It's understandable. But yeah, just to reiterate, guys, to everyone who's tuned in, there will be space for Q&A at the end. So make sure to just write down your questions into the chat, and then I'll address them to Christina when we have the time at the end. We're just keeping everyone muted for the time being to keep the clarity of the audio.
Yeah, thanks for that. So, sorry, as I was saying, some of the issues underlying the corporate governance theme is executive compensation. And this is one of the short-term pressure factors that I mentioned earlier. Now, the reason why it's here is because being transparent about what executive compensation is linked to builds trust, and trust is really the basis for an open dialogue. So, especially when CEO compensation is tied to long-term performance of the company or to sustainability targets, this gives investors a signal as to what they can expect to be a priority for the company too. The other themes here are competitive positioning, risks and opportunities, human capital, and long-term value creation. Including these into this discussion about what a long-term plan for a company is will provide the most useful information for investors. And we do see this framework evolving over time. So as more and more companies discuss their long-term thinking, and as more investors ask for information on topics that they consider material, so financially relevant, we think that this framework can expand and become more specific. I won't go into further detail on each of these issues, but you can read more about them in our report on our website. So great. We now have the topics that companies should disclose more on, but what kind of information is most useful? As it stands, most corporate reporting is of course backward-looking. So it consists of lagging indicators, and a long-term plan presentation is really an opportunity to disclose specific and actionable forward-looking information about the issues that are critical to the company's ability to create long-term value. And what we realized when we analyzed the long-term plans at the CEO Investor Forum was that quite often companies might only discuss briefly the priorities on these issues without providing actual numerical data or time-bound targets. And I've picked out two examples, which you can see here below, on the theme of capital allocation plans. The first one is our capital is going to be more focused on our retail business so we can provide better solutions to our customers. Okay, that sounds great, but anyone could really say that. This doesn't actually provide any information as to by how much, by when, and so on. If we look at the other example, we can really see a clear difference. And this is a great example of effective disclosure by the CEO of Becton Dickinson, where he provided a very detailed plan for the next 3 years in terms of projected use of their 11 billion operating cash flow. He stated that 3 billion will go to capital expenditure, 2.6 will be paid out in dividends, 1.4 debt pay down, and 4 billion in remaining cash. So you can really see how this type of disclosure on the long-term plans gives both the quantifiable targets and a timeline. So this is much more useful for an investor to hear compared to the previous one. And by looking at the type of disclosure per theme, we found a lot of variation in the quality of disclosures across the themes and issues. So it seems that companies are finding it easier to provide forward-looking information on some issues, or for example, their competitive positioning, future trends, and financial performance metrics. These are really the issues that historically have been assessed elsewhere in corporate reporting. So it might not be very surprising that these are the themes that companies seem to be more comfortable with disclosing forward-looking information on. We found least forward-looking information on the corporate governance theme. And this is a really interesting finding because it seems like it's still uncommon to provide disclosure on how the composition of the board can guide long-term strategic goals, what the plan is for shareholder engagement, and how executive compensation is linked to long-term performance, for example. And here, a lot of companies are talking about these issues, but they're only mentioning what they've done in the past. So not very useful for investors there. Secondly, we also found variation across the quality of overall company presentations. And it became quite clear that those companies that have better overall scores, they were also harder to evaluate. And it seems like the leading companies included long-term thinking throughout the presentation and across all of the themes in our framework, which were these ones. The disclosure wasn't provided in isolation, but rather they showed how all of those separate issues are linking together into an overarching long-term strategy. And what we did then after having scored the companies in terms of the content of their long-term plan was that we linked those presentations that had more of the quantifiable and forward-looking information to the actual market reaction. And our results suggest that those companies that provide more actionable and specific quantifiable data, they also had a larger market reaction. So still keeping in mind that our sample was very small, but this is really exciting as it provides direction both on the topic and then the type of disclosure that markets value. So to summarize the discussion today, to shift the focus of capital markets to the long term, one solution is to provide effective long-term disclosures. Okay, but how? Well, our results show that the most effective corporate communication of long-term strategy is when companies provide a high degree of specificity in their discussions, combined with a detailed and credible projections of the future. So companies should really voice their long-term strategies to investors to drive sustainable long-term value creation. If companies don't provide this information, investors can engage with the company that they've invested in to pressure for better disclosures. And for example, a starting point could be to start asking about this during the quarterly calls. We've seen some of that already, which is a really, really good sign of the shifting the focus towards the long term. And the cool thing is that companies seem to attract investors based on the type of information that they give out. So providing more long-term information might actually change the investor base of a company to being more long-term focused too. So going forward, companies should really voice their long-term strategies to investors so that they can drive sustainable long-term value creation. And there are loads of amazing initiatives out there that are assisting in driving this change, like CCP or FCLT Global or Finance for a Sustainable Future. From the KKS side, we're going to continue to study the relationships and do more research that can assist in helping companies and CEOs create more effective long-term plans. And we really believe that we can help both investors and companies in driving this shift from short-term to the long-term. And this is really our broader vision to reshape markets. Thank you. Sorry about the throat thing. I have a bit of a flu. Are there any questions now? I'd be happy to answer any questions that you guys might have.
Yeah, thanks a lot for this amazing webinar, Christina, and no worries whatsoever about the confusion there. So yeah, just to remind everyone, if you have any questions to Christina, drop them down in the chat. You should have it on the right of your Zoom page or screen, depending on what platform you're using. So just before you guys have any specific questions that you'll type in, I had some from my side. So you mentioned an interesting point that one of the key reasons about the short-termism on the corporate side is the remuneration strategies. So, linked bonuses to quarterly performances and the short-term sort of nature of extra rewards. And so one way to address that would be to shift that to the long term. Have you seen any specific examples in companies doing that, or something that has been successful and is scaling up in the general sectors?
Yeah, that's a really interesting question. We actually saw at the CEO Investor Forum, one of the really advanced companies in terms of the quality of their disclosure was energy. And they basically, their CEO was talking about his own executive compensation. And this can be something that is quite an awkward topic to talk about as a CEO, because you're basically discussing your own salary. But he was saying how much of his salary and the executive team's compensation was actually linked to the long-term performance of the company. He said that 80% of the executive management compensation is tied to long-term performance. So that was really, really interesting. We've also seen through a lot of our other research, we did this research piece together with series called Systems Rule, How Board Governance Can Drive Sustainability Performance. And here we found that companies have started also not only linking the executive remuneration to the sustainability or long-term performance, but also to stakeholders. So, for example, how compensation is linked to employee engagement ratings, how it's linked to impacts on suppliers, on customers, on the environment. So there has really been this shift, but we have a really long way to go still when it comes to that.
Yeah, that's a great answer. Thanks a lot for that. And just maybe to follow up on that, so you mentioned that an example being energy. So from an energy or utility sector, in the general debate of the long versus short-termism, are there any sectors of economy that stand out of being a bit more proactive in terms of long-term disclosure, or it's a sort of uniform kind of drawback of businesses?
Yeah, that's really interesting. So we actually, well, to begin with, the companies that we analyzed, you need to keep in mind that those are already kind of the leaders, because those are the ones that have voluntarily stepped up and attended the CEO Investor Forum organized by CCP. So those are the companies that are saying, hey, you know what? I'm going to go out there and in public, I'm going to explain to all of my investors our long-term strategy for the company. But if you look at that sample, you can already see that there seems to be a lot of pharmaceutical companies, a lot of energy companies like utilities, and it's not maybe that surprising, because if you think about the inherent nature of the products and services that these sectors like the pharma or the utilities provide, they've always required a bit more long-term planning. So for example, the pharmaceutical industry, it takes a lot of time for a pharmaceutical company to create and have approval for new products. I think it's on average like 10, 12 years or something for them to have a product out on the market. Likewise, the utilities, there's a lot of investment required up front to build the infrastructure to be able to supply energy or water or whatever they might be supplying. So these are the kind of companies that might have those kind of long-term metrics and data readily available. And it's probably something that they've been asked for quite frequently in the past as well. The other interesting thing there is that in the United States, companies are required, so public companies are required to report quarterly earnings. And in Europe, they're not. So you have some, like I think Unilever announced that they're not gonna do quarterly earnings calls anymore. They're gonna do them much less frequently because they're not forced to, and they don't see the benefit of reporting quarterly. So there is that difference when it comes to the sectors, but also when it comes to the regions. Some regions are a bit more advanced when thinking about sustainability, for example, than others.
Yeah, that's a great overview of that, and also bringing in the regulation differences, because that's pretty interesting to just compare not only across sectors, but across geographies. It's like a, bringing in policy to the debate. But yeah, thanks a lot for these answers. And maybe I'll just finish off with a more general one. As Finance for Sustainable Future is targeted to young professionals and probably, finance students just entering the actual career space, do you have any more like personal level advice to young professionals and students coming in how to engage with the sustainability broader debate within finance?
Yeah, of course. So as a young professional myself, having just recently started or kicked off my career at KKS, I think what I've learned is the value of networking, the value of just being brave and reaching out to people, making contacts. You really never know how and when the people that you meet might come in useful, and you might also be able to give something to those people that you meet later on in your career as well. So I really think taking the initiative, going to conferences, attending webinars like this one, really trying to be a sponge and soak up all kinds of knowledge from people that are working in the field. I think that's really important.
Yeah, thanks a lot. All great points. Just want to quickly ask if anyone else from you guys has any questions. Just drop them down. Otherwise, we're probably going to be wrapping up. Yeah, seeing that nothing's coming, I would just want to thank you, Christina, so much for this very interactive and engaging webinar. Lots of interesting points there and lots of interesting personal tips at the end as well. And thank you for the mention of Finance for Sustainable Future as one of the organizations that are active in the field.
Of course. You guys have a really cool initiative going on. Yeah, I think it's really important that people learn about the possibilities of sustainability within finance from an early age.
Yeah, thanks a lot. So just as a practical point, we will be sending out a feedback form at the end. So if you guys have any suggestions, requests or general comments about the format or the content of the talk, let us know, and make sure you stay subscribed to our newsletter, spread it among your friends or anyone who would ever be interested on our website, financeforsustainablefuture.org, or just follow our social media pages, and make sure to check out KKS Advisors page for all the amazing research and other work they do that Christina mentioned. And if you would like to know anything more about what we do or what's going on, feel free to get in touch with any of us from the team. Thanks a lot, Christina, again, and thanks a lot for everyone who tuned in.
Thank you so much.
Bye.
Bye.